Gold is supposed to be safe. Silver is supposed to follow. So why do gold and silver stocks move like tech startups? If gold is stability, why do mining stocks crash 40% in a few months? Today, we're breaking down the real reason precious metals are so volatile, and why gold and silver stocks amplify every move. No hype, no conspiracy theories, just structure. First, understand this. Gold does not move randomly, it reacts to macro pressure. There are three major forces that drive gold prices. Number one, real interest rates. Gold pays no yield, so when interest rates rise, investors can earn money elsewhere. That makes gold less attractive, but when real rates fall or go negative, gold becomes more appealing. That's when big rallies begin. Number two, the US dollar. Gold and silver are priced in dollars. When the dollar strengthens, metals often weaken. When the dollar falls, metals tend to rise. Watch the dollar index and you'll often see the inverse relationship clearly. This is currency mechanics, not emotion. Number three, fear and liquidity. During financial stress, geopolitical tension, or economic uncertainty, capital flows into perceived safe assets. Gold benefits from that. But here's the twist. In severe liquidity events, gold can drop. Why? Because investors sell what they can to raise cash. Even safe assets get liquidated temporarily. That's where volatility spikes. Now let's talk about mining stocks. Now, this is where things get amplified. A gold mining company has production costs. Let's say it costs them $1,600 to produce 1 ounce of gold. If gold trades at $1,700, they make $100 per ounce. But if gold rises to $1,900, their margin jumps to $300 per ounce. That's a 200% increase in profit from a relatively small move in gold. This is called operational leverage, and it's why mining stocks move faster than gold itself. But leverage works both ways. If gold falls below production costs, margins compress rapidly. Investors panic, and stocks can collapse quickly. Now add in political risk, energy costs, environmental regulations, management execution risk, and you get a sector that magnifies every macro move. Junior mining companies? Even more extreme. Many of them don't produce gold yet, they explore for it. Their valuation depends on future discoveries. Speculation drives price. That's why juniors can surge 300% in months and lose 80% just as fast. Liquidity is thin. Sentiment shifts quickly. This is not a defensive sector. It's cyclical and aggressive. Now let's shift to silver. Silver is different. It's part precious metal and part industrial commodity. Over half of silver demand comes from industrial uses. Electronics, solar panels, medical technology. That means silver reacts not only to fear, but also to economic growth. In strong economic cycles, silver can outperform gold. In slowdowns, it can drop harder. This dual identity makes silver historically more volatile than gold. And silver mining stocks, even more amplified. Smaller companies, lower liquidity, higher speculation, faster moves. So what creates explosive breakouts in precious metals? Usually three conditions align. When those forces combine, capital rotates aggressively into metals and mining stocks. ETF inflows increase, momentum traders enter, media coverage rises. That's when parabolic moves happen. But when those conditions reverse, volatility returns. Late buyers often get trapped. Now the important question, should you trade metals or hold them long term? There are two distinct strategies. The first is the insurance mindset. Some investors hold physical gold or large cap miners as portfolio protection. They're hedging systemic risk, they're not chasing returns. The second is tactical positioning. These investors monitor real rates, dollar strength, inflation expectations, ETF flows, and they scale in when macro conditions shift in their favor. The mistake most people make, buying emotionally during headlines, precious metals punish impatience, they reward structure. Gold and silver are not just shiny commodities, they're macro instruments. Mining stocks are not stable utilities. They're leveraged plays on sentiment, currency, and policy. If you understand what drives volatility, you stop reacting emotionally, and you start positioning strategically. Because in precious metals, volatility isn't the enemy. Misunderstanding it is.